Market bubbles and crashes are not anomalies in economic history. They are its recurring psychological dramas, replayed with new assets and new language, but driven by the same ancient impulses. When I look at bubbles, I do not begin with charts or valuation metrics, but with human emotion, because long before markets were digital, fear and greed were already perfectly analog. Every bubble is born, not from ignorance, but from the belief that this time the future has arrived early, that risk has been conquered, that old rules no longer apply. And every crash is the moment when that belief collapses under the weight of reality, revealing that markets, like people, are far more emotional than rational. The earliest bubbles teach us this clearly. In the Dutch tulip mania of the 1630s, often caricatured as madness prices, rose not because tulips were useless, but because they became symbols of status, novelty, and participation in a rising commercial society. Rare bulbs where scarce contracts were liquid, and stories of easy wealth spread faster than sober analysis. What mattered psychologically was not the flower, but the narrative prosperity could now be accelerated, democratized, and captured before others did. Bubbles thrive when opportunity feels both limitless and fleeting. The fear of missing out proves stronger than the fear of loss. This pattern repeated with remarkable consistency. The South Sea bubble in 1720 was fueled by vague promises of future trade and state endorsement. Investors were not fools. They were extrapolating from recent success and trusting political authority. The Mississippi bubble in France followed the same script. What these episodes reveal is that bubbles form where optimism, innovation, and institutional credibility intersect. They are not caused by deception alone, but by alignment between hope and plausibility. When a story sounds just believable enough, the mind fills in the gaps. Psychologically, bubbles feed on social proof. As prices rise, skepticism becomes costly. Those who question the trend underperform their peers, and doubt begins to feel like ignorance. Humans are social learners. We infer truth from collective behavior. In markets, this instinct becomes dangerous. Rising prices validate belief, belief attracts new buyers, and new buyers push prices higher. This reflexivity, as George Soros later described it, creates a feedback loop where perception shapes reality until reality pushes back. The longer the loop runs, the more fragile it becomes. Crucially, intelligence does not inoculate against bubbles. History shows that highly educated, well-informed participants are often the most exposed. They construct the most convincing justifications. During the Roaring Twenties, investors believed mass production, electrification, and modern management had eliminated the business cycle. In the late 1990s, the internet was real, transformative, and misunderstood in its timing. In the 2000s, financial engineering promised to distribute risk so effectively that systemic failure seemed impossible. Each time the logic contained truth, and that truth made the excess believable. Leverage intensifies psychology. Borrowed money compresses time. Gains feel urgent. Losses feel existential. As leverage rises, tolerance for volatility shrinks, even as exposure increases. This is why bubbles often appear calm near their peak. Volatility falls because belief is unanimous. Dissent has been priced out. At that moment, markets are not stable. They are brittle. A small shock can trigger forced selling, margin calls, and cascading exits. What looked like confidence reveals itself as dependency. Crashes, when they arrive, are not mirror images of bubbles. They are psychologically asymmetrical. Fear spreads faster than greed because loss is felt more intensely than gain. Narratives reverse overnight. What was innovation becomes illusion. What was prudence becomes cowardice. In 1929, 2000, and 2008, the same phenomenon appeared once prices began to fall, Participants rushed not to be right, but to survive. Liquidity vanished precisely when it was most needed. Trust evaporated. The crowd that once provided comfort now provided threat. What makes crashes so destructive is not price, decline alone, but the collapse of confidence in one's own judgment. People do not simply lose money. They lose their sense of orientation. This psychological damage lingers far longer than financial loss. It shapes behavior for decades. Survivors of the Great Depression saved obsessively. Survivors of hyperinflation distrust currency. Survivors of asset bubbles become either permanently cautious or permanently cynical. Markets remember through people. History also shows that policy responses interact with psychology in powerful ways. Delayed intervention reinforces fear. Overconfident reassurance undermines credibility. The most successful crisis responses are not those that deny pain, but those that restore a sense of floor beneath the system. When participants believe losses are bounded, panic slows. When they believe nothing is safe, everything is sold. Central banks learned this lesson the hard way across the 20th century. Yet perhaps the most uncomfortable truth is that bubbles are not purely failures. They are also engines of progress. Railroads, canals, electricity, automobiles, and the internet all expanded through speculative excess. Capital poured in, too fast valuations overshot, and many investors were ruined. But infrastructure remained. Knowledge accumulated. Society moved forward. This creates a moral ambiguity at the heart of bubbles. They waste capital and build futures simultaneously. History does not excuse the damage, but it explains why bubbles keep returning, despite repeated warnings. The psychology of bubbles and crashes, then, is not a defect to be engineered away. It is an expression of human nature interacting with uncertainty storytelling and social behavior. Every generation believes it is more sophisticated than the last. Every generation is eventually reminded that emotion scales faster than wisdom. The question is not whether bubbles will occur again, but whether individuals and institutions will recognize the signs early enough to manage exposure, because bubbles only feel obvious in hindsight, and it is precisely in the moment, when optimism feels most justified, that risk is most mispriced, and the crowd is most certain that this time the cycle has been defeated, and history has finally been rendered obsolete. Just as the story reaches the point where confidence quietly turns into complacency, and the psychological tipping point approaches when belief no longer needs confirmation, and the market begins to float not on cash flows or fundamentals, but on something far more fragile, which is collective conviction. Because once belief itself becomes the asset being traded, markets enter their most dangerous phase. At this stage of a bubble, participants are no longer buying because prices will rise. They are buying because others will buy. The distinction is subtle but decisive. Fundamentals fade into background noise. Valuations are reframed as outdated concepts. Risk managers are sidelined. Language shifts from analysis to destiny. History shows that this is the moment when warning signs multiply even as they are dismissed most aggressively, because acknowledging them would threaten identity status and belonging within the crowd. In this late phase, narratives harden. Any setback is interpreted as proof of resilience. Any critic is accused of not getting it. Psychological anchoring locks expectations to recent gains, making reversal feel impossible. This is why peaks often arrive with serenity rather than panic. Volatility is low. Confidence is high. Participation feels universal. The market appears to have discovered a new equilibrium, but in reality, it has exhausted marginal buyers. With leverage elevated and liquidity thin, the system becomes exquisitely sensitive to surprise. It does not take a catastrophe to trigger a crash. only a disappointment. When the turn comes, it is rarely announced. A missed earnings report, a policy shift, a failed auction, small events that would have been absorbed earlier now carry outsized impact. Prices fall just enough to challenge the narrative. Leverage begins to unwind. Forced selling replaces voluntary participation. The psychological switch flips from extrapolation to preservation. People do not ask what an asset is worth, they ask whether they can get out. This is the defining moment of a crash, the realization that liquidity was an illusion created by shared belief. Crashes accelerate because they reverse the same social dynamics that built the bubble. Social proof works in both directions. Selling validates selling. Silence feels dangerous. Cash becomes precious. Loss aversion overwhelms long-term thinking. Markets overshoot on the downside, just as they did on the upside, not because fundamentals justify it, but because fear demands certainty, and certainty can only be found in exit. History teaches us that the most severe damage occurs not at the peak, but during this rapid psychological reorientation, when institutions and individuals discover how little margin for error they truly had. The aftermath is where the deepest lessons reside. After a crash, narratives invert. Innovation is recast as fraud. Optimism is punished socially. Survivors rewrite history to emphasize prudence, while forgetting how persuasive the story once was. Regulation tightens, memory hardens. For a time, markets behave cautiously scarred by loss. Then gradually the scars fade. New participants arrive without memory of pain. New technologies emerge. New stories sound different enough to feel safe. And the cycle begins again, not because people are foolish, but because progress itself creates uncertainty, and uncertainty invites storytelling. What distinguishes those who endure from those who are repeatedly consumed by bubbles is not superior intelligence, but emotional discipline. History suggests that successful participants cultivate distance from the crowd, respect leverage as a moral hazard, and treat narratives as hypotheses rather than truths. They understand that markets are not weighing machines in the short run. They are voting machines powered by emotion. They also understand that stepping aside during euphoria feels harder than acting during panic, because the cost of missing out is social as much as financial. For policymakers, the psychological dimension poses a persistent dilemma. Intervene too early, and you risk legitimizing excess. Intervene too late, and you allow panic to metastasize. The most effective responses acknowledge fear without validating fantasy providing liquidity while reasserting limits. History offers no perfect formula, only patterns. Each crisis teaches the same lesson in different language. Credibility is the scarcest asset in a crash, and it cannot be improvised. The psychology of bubbles and crashes, then, is not a flaw to be eliminated, but a force to be respected. It arises from the same instincts that enable cooperation, innovation, and growth. Markets amplify these instincts. Sometimes they channel them productively. Sometimes they do not. Understanding this does not grant immunity, but it offers orientation. It reminds us that humility is an edge, that skepticism is not cynicism, and that the most dangerous words in finance are not panic or fear, but everyone knows. If this exploration of market psychology has resonated with you, I invite you to subscribe and continue these journeys through financial history with me, and to leave a comment sharing which bubble you believe best illustrates these patterns, because history does not prevent repetition, but it does reward those who recognize the moment when confidence quietly transforms into certainty, and certainty becomes the prelude to collapse.